Well, it has been an absolutely brutal week here in the world of SoFi Technologies, with the stock pulling back sharply after a brief moment of extreme optimism. We saw the share price rally hard to hit over $18 just days ago, but sellers took control and dragged us back down to the $16 range on massive volume. We need to look past the immediate panic and focus on the fundamental realities driving this price action. We are watching a classic tug of war between short-term technical resistance and the long-term shift towards sustained profitability. This is purely my opinion and my personal journey, so you should always do your own research first to make informed choices. The sudden pullback has left a lot of retail investors feeling incredibly frustrated and confused about where this business is headed next. We must separate the daily noise of the stock chart from the underlying performance of the company to understand the true value. The reality is that this business is transitioning into a mature financial powerhouse, but the market is demanding perfection at every single step. 3 weeks ago, we analyzed how the market was pricing in a lot of skepticism leading up to the first quarter earnings release. Many traders were convinced that a post-earnings sell-off was inevitable, and they were proven right when the stock plummeted 15% immediately after reporting. That drop seemed completely disconnected from the actual operation because the underlying business actually delivered record figures across the board. I pointed out that the massive gap between strong financial results and the negative stock reaction was driven by conservative guidance. The market was looking at flat full-year projections and decided to punish the stock regardless of the record-breaking numbers that just printed. Then, a massive relief rally pushed the stock up 17% in 5 trading days at the end of May. This sudden spike caught short sellers off guard, forcing them to cover on massive volume. That run looked like a breakout, but we warned that chasing the stock near $18.50 was highly risky. Now we are seeing the exact pullback we anticipated as the initial excitement cools down and the broader market consolidates. This is why we have to remain calm, avoid emotional decisions, and look at the actual catalysts moving the needle. We have consistently emphasized that a layered entry plan beats a lump sum buy when dealing with high volatility growth stocks. If you chase the stock during the massive end of May run, you are likely feeling a lot of pain right now as those quick gains evaporate. This is a classic pattern for this stock, which has spent months looking like a comeback story before giving back gains. The business has successfully transitioned into a profitable national bank, but the share price still behaves like a speculative tech play. This disconnect presents a massive opportunity for investors who can keep a level head and look at the hard data. We are going to analyze exactly why the stock is sliding today and what the long-term outlook holds for our capital. The sudden rise and subsequent fall of the stock over the past 2 weeks can be tied directly to 3 major catalysts. The first massive catalyst was the launch of SoFiUSD, which is a dollar-peg stablecoin issued directly by the regulated bank entity. This is a massive milestone because they are the first U.S. national bank to offer this natively inside their mobile app. By utilizing both the Ethereum and Solana blockchains, they are positioning themselves to capture high-margin transaction fees and tokenized interest-bearing deposits. This announcement originally triggered the late May rally because it highlighted a technological moat that traditional banks simply cannot match. Integrating blockchain into a federally regulated banking system is a massive step for the entire fintech industry. It represents a brand new capital-light revenue stream that could significantly boost profitability over the next few years. The second major catalyst involves the shifting macroeconomic landscape and the outlook for interest rates in 2026. Recent economic data suggests further rate hikes are highly unlikely, providing a sigh of relief for fintech lenders. Although rate cuts are off the table for 2026, rate stability helps protect net interest margins and loan demand. This macro shift brought a lot of institutional buyers back into the fold, supporting the sudden surge in trading volume. Investors are starting to realize that the company can thrive even if interest rates remain higher for longer. However, the third and most painful catalyst is the persistent overhang from the first quarter earnings report that dropped in late April. Even though the headline numbers were outstanding, the technology platform segment suffered a major blow that investors are still digesting. Galileo lost Chime as a major enterprise client, causing the platform's quarterly revenue to plunge 27% to $75 million. That loss created serious doubts about the long-term growth trajectory of their business-to-business segment, which is supposed to be their capital-light growth engine. Analysts had placed a high valuation multiple on the stock specifically because they expected the Galileo technology platform to scale rapidly. A 27% drop in that segment's revenue is a jarring contradiction to the hypergrowth narrative, forcing a valuation re-rating. To make matters worse, management kept full-year revenue growth guidance flat at 30%, which disappointed analysts wanting an upgraded outlook. The early June pullback is a direct consequence of the stock hitting heavy technical resistance near $18.50. Traders decided to lock in quick gains from the stablecoin announcement, and the stock fell over 7% on June 5th. The bearish turn in technical indicators like the moving average convergence divergence and the relative strength index has accelerated the downward pressure. This combination of profit-taking, a key client loss, and technical rejection has brought us straight back into major support territory. We also saw some institutional selling pressure as major investment firms like BIT Capital reduced their exposure during the late May peak. This kind of insider and institutional profit-taking often signals to the market that the stock has run too far, too fast. The introduction of SoFi Coach, an artificial intelligence financial assistant, was a positive step, but it was not enough to offset the broader selling pressure. The market is currently valuing the company as a premium tech stock while treating its lending business with the skepticism of a traditional bank. This duality is creating a highly volatile environment where any piece of minor negative news can trigger a major sell-off. We must accept that this volatility is here to stay as long as the market remains undecided on how to categorize the business. The transition from a simple student loan refinancer to a full-service digital bank is almost complete, but the final leg is always the hardest. To truly understand the value of the company, we must move past the headlines and look at the actual fundamental numbers. In the first quarter, the business delivered record-adjusted net revenue of $1.1 billion, up 41% year over year. This represents the 10th consecutive quarter of positive net income under general accepted accounting principles, proving that their business model is highly sustainable. Net income skyrocketed by 134% to reach $167 million, up from last year. This translated to diluted earnings per share of 12 cents, which perfectly matched the high end of Wall Street expectations. Customer acquisition remains strong, adding over 1 million new members in the first quarter to reach nearly 15 million members. That is a 35% increase in membership year over year, which is outstanding for a mature financial platform. Total product adoption also rose by 39% to reach over 22 million products, showing that members are using multiple services. The cross-buying rate, where existing members adopt secondary products like credit cards or investment accounts, increased by 43%. This cross-selling mechanism is the secret weapon of their business model because it drastically reduces customer acquisition costs and boosts lifetime value. On the lending side, total loan originations hit a record $12.2 billion across personal, student, and home loans. The personal loan segment continues to perform well, with newer loan vintages showing credit losses lower than older vintages. Their average personal loan borrower has an income of $154,000 and a high credit score. This high-income, high-credit score borrower profile heavily insulates the bank from potential default risks in a cooling economy. Looking at the balance sheet, the bank is sitting on over $3.4 billion in cash. The national bank charter allows them to fund their loans using cheap member deposits instead of expensive warehouse lines of credit. This deposit-funded model saves them millions of dollars in interest expenses and allows them to maintain a strong net interest margin. However, when we look at the valuation, we can see why some analysts are calling the stock overvalued at current levels. The stock currently trades at a price-to-earnings multiple of roughly 39 times, significantly higher than the consumer finance industry average of 9 times. Even when compared to closest fintech peers trading at 12 times earnings, the company carries a massive premium. This high multiple means that the market is already pricing in a massive amount of future execution. If the technology platform does not re-accelerate, the stock will struggle to justify this premium multiple over the next 12 months. The price-to-sales ratio sits near 5 times, which is reasonable for a software business, but quite high for a bank. The price-to-book ratio is around 1.9 times, showing that investors are paying a premium for the company's net assets. We must balance this rich valuation against the company's projected 30% compound annual revenue growth rate. Maintaining this explosive growth while expanding margins will help them grow into their current valuation. To help you process this market volatility, we can divide our community into 3 practical hypothetical situation groups. Group 1 consists of short-term traders who bought near $15 and rode the wave up to $18. If you are in this group and currently stressing over the recent pullback, it is a great idea to secure some profits. Taking some money off the table is a normal and healthy part of building a long-term portfolio. You should never feel guilty for locking in a quick 20% gain, especially in a stock as volatile as this one. Group 2 represents the long-term believers who are building a position to hold for the next 5 to 10 years. If you belong in this category, these short-term price swings are nothing more than background noise. The underlying business is executing beautifully, and a pullback to the $15 or $16 level is a healthy cooling period. Look at these dips as opportunities to accumulate more shares at a reasonable valuation rather than reasons to panic. Group 3 is made up of sideline buyers who are feeling a massive amount of FOMO and want to get into the stock. Buying at peak excitement when the stock is surging past $18 is exactly how retail investors become market victims. The smart move is to ladder in slowly by putting a small portion of capital to work during red days. By spreading your purchases over several weeks, you can lower your average cost basis and protect yourself from sudden drops. Patience is the ultimate competitive advantage in the stock market, and chasing green candles is a recipe for disaster. The recent slide in SoFi Technologies stock is not a sign of fundamental decay, but a healthy market correction after an unsustainable run. The underlying business remains highly profitable, customer adoption is at record highs, and the new stablecoin initiative could be a massive game changer. However, the rich valuation multiple means that we must remain disciplined and avoid chasing the stock during periods of hype. We will continue to monitor the execution of the technology platform and the overall credit quality of their loan portfolio. This is presented for educational comparison only, so please make your own informed decisions based on your personal financial goals. Thanks for watching. I'll keep you updated as this all plays out, and I cannot wait to see you in the next one.